Hello and welcome to another episode of משקיעים בקשר, Relations and Investors. I'm Rami Rozen.
And I'm Daphna Golden. Today's our first episode in English. So first of all, we're excited, obviously.
Very.
And not only we're excited because it's in English, but also because we're hosting a special guest today, Joseph Wolf. Today, the CEO of EFG Wealth Management Israel.
Yeah, Joseph has an impressive background in the financial industry. CEO of EFG, before that of Credit Suisse in Israel. He led sell-side research teams in both Israel and New York City for the most well-known banks like Barclays, Lehman Brothers, and UBS, right, Joseph?
Right?
Correct.
Yeah. And I think, Joseph, if I'm not mistaken, your most recent role in a research position, was in Barclays, where you were Deputy Director of U.S. Equity Research.
Yes.
Yep. And you were also on the Research Executive Committee and Investment Policy Committee at Barclays.
Indeed.
Impressive.
The good old days.
Yeah.
Impressive.
Joseph, thank you so much for joining us. Again, really exciting and to dive into your experiences and insights.
It is excellent to be here. A couple of old investment community friends from the Israeli market.
Thank you. Okay, so Joseph, how about if we actually start from your basics? I'd say talking about your roles as a research analyst, taking that part of your career. So what do you think is, I'd say, first of all, what would such a role contain, you think? And if you can talk about your path, actually, and how it's evolved.
All right. I'll talk a little bit about myself. So I was a failed engineer. I had an undergraduate degree in engineering. I worked as an engineer for a few years, and I realized that was not really the path for me. So I went back to a school that I will no longer name and got an MBA. During that process, I would say that when I went to business school, I don't think my goal was to get into equity research because, frankly, I hadn't spent enough time looking at the markets to really even think about that path. But quickly, in the business school environment, I learned a lot about equity research and the opportunity set, especially for someone with a technology background. And so I was able to, after getting my MBA, join a team that was covering deep technology stocks at the time, telecommunications equipment, which drew on my past experiences, especially in the fiber optic communications technology world. And so I came in with a very, very specific background. I had the technology background, and then I had the finance background from the business school, and so I was able to combine those two things together, and that was my first role on Wall Street.
That was UBS?
That was with UBS in New York. About 5 years later, I picked up a move to Israel, which is, as a side note, the fact that we're doing this in English is either very, very important because I think English remains the language of most of what this conversation talks about. Mm-hmm. On the other hand, it could be quite embarrassing since I have lived in Israel for 20 years and we're doing this in English, but we'll leave that for another time. I have a perfect run-on a Hebrew accent. Yeah. After that, I moved to Israel, and what was interesting about the move to Israel is I came to Israel with UBS as well. But I started out covering domestic Israeli stocks. And so the transition that I made at that point was I moved from tech into domestic Israel. And so I started covering bank stocks. I started covering some telecommunication stocks. I covered Israel Chemical. And so what I learned in that situation, at least for me, was, and I still tell people this sort of almost in a joking fashion, but not really actually, the most important rule in tech investing is that if you have to look at the balance sheet, it's too late. But when I moved over to covering real companies and real sectors like Israel Chemical, which pays a dividend and has a real balance sheet and real cash flow, I learned a lot about the other side of analysis that you don't spend as much time to, or at least we didn't spend as much time in the past when you're looking at very growthy tech stocks. After that, like all good Israelis, and we could talk a little bit about some of the firms I worked at over time, but like all good Israelis, I got a promotion back to New York, but I didn't move, so I traveled a lot. But my last role at Barclays was in management, where I covered stocks for a little while, but I also had primary managerial responsibility for a lot of the publishing analysts on the U.S. team in Barclays, spanning technology, healthcare, and just about every other sector. So that's sort of the path that took me here. And then a couple of years ago, I made a change to wealth management, and that's where I find myself in my current role.
And that's EFG.
And that's at EFG.
Yeah. So we want to focus on the sell-side analysis part of the career. So when you are looking at this profession of being a sell-side analyst, what were the most challenging aspects of working as one, and what skills do you think are essential for succeeding in this role?
So I think being an analyst is one of the most complicated jobs on Wall Street, and the reason for that is first on the actual requirements to just do the job. You have to have multiple skill sets, and so you need to have the analytical training in terms of actually doing the analytics and doing the accounting work and the balance sheet and the cash flow analysis and the income statement. But you also need to be able to communicate that. And so it's not enough to just be a guy who's good at numbers. You actually have to, at the end of the day, and it's called the sell side. And I think one of the things that I learned, it probably took me a little bit too long to figure this out, but it's called the sell side for a reason. You're not sitting there in some research ivory tower distributing reports that the world will someday act upon, because there are plenty of people writing research about the stocks that you're covering. So the real job of the sell side is to sell. And the important part about selling is you've got a whole lot of different customer bases, even within your own firm. And that's what makes this challenging, because you're publishing for effectively the buy side. Those are your primary clients. Mm-hmm. But there are a bunch of different people on the buy side. And so you have faster money clients who trade every single day, and you have buy and hold investors who have a much different time horizon. That has shifted over time. But when you put a rating on a stock, what that means is different to different parts of your client base even. And then you've got other people who you're also selling this to. And so most firms, and I think you will address this in one of your other episodes, is you've got the sales and trading organization. The sales and trading organization in the firm is also very important and significant. And they listen to what you say, because the trading desk creates volume and activity in most of the stocks. And they read what you write carefully. But you'll wake up in the morning and there's news out there, and you have to respond, but you have to respond within the context of what your rating is. And so You've got a buy rating, but bad news comes out, and your trading desk calls you what to do. And you can't change your rating on the spot, but you also can't not answer the traders. And so you have to deal that fine line between facts, what the immediate impact of the stock is, but then you have to go back and you have to be quiet, and you have to live within the compliance and regulatory framework, and you have to answer the question in the way that you can, and then publish the work so that it can be consumed by everybody at the same time. Otherwise, you're really you're stretching the limits of what is really compliant at that point. So those are a couple of clients, and then of course you've got the companies, because the companies care a lot about what you write, and the reason that they care a lot about what you write is because you are part of the marketing arm almost of the companies when it comes to learning about the company. And so, a lot of times companies will look at a research report that a good analyst has written, and they'll even use parts of it at a board meeting, because analysts have a lot of access. Mm-hmm. And many times, you've got these companies, and now that you've been on both sides, you see this. When you're an analyst, you talk to every company in the sector. Every individual company can't necessarily do that. And so you may know more about their competitors than they do to a certain extent. They know more about the day-to-day in the competitive landscape, but you know more about the nuts and bolts of that other company. And so they look at a lot of what you do as you're a sector specialist. Mm-hmm. And so that you've got companies who can call you up and say, hey, you made a mistake on page 15, fix it. And so you've got a lot of different customer bases with the exact same piece of research that you're writing, and you have to answer to all of them on any given day. And so that becomes a very complicated tightrope to walk at times.
Yeah. And I think you're certainly, the comment about being like sort of a marketing arm for me, as an IR person, it's definitely.
We talked about that, I think, in the last episode.
Yeah. Now, if I look back at your career, I'd say the financial markets career, it's at least 20 years, over 20 years.
It's over 20 years.
So I'd say, and I think that's also a true statement. Actually, I know it's a true statement that you've experienced, I'd say, some of the craziest times in the financial markets. Leave aside what we've been seeing recently. But if I go back even to, say, 2008, okay, with the banks and the subprime and all that stuff. So in general, or I don't know if you could give an example of meaningful experience for you as an analyst when going through one of, I'd say, those crazy periods.
I think that I go even further back because I am that old. I think so I experienced different financial inflection points, let's call them, from different angles. And so in 2000, I was a tech analyst in the hottest sector in technology, and then you had the NASDAQ crash. And so I went through that as an analyst, where all of a sudden the market cap, the most popular or the highest flying stock that I covered went from, and this was a real decline and a total collapse in demand for product. And people had been talking about an overbuild of the telecom sector for a couple of years, and then you saw it happen. And if you looked at the inventory and if you looked at the order books, you just totally got confused. And I'll tell a story about where I made the biggest mistake, and I was a young analyst at the time. In October of 2000, I believe, maybe it was 2001, Nortel Networks, which is an old name from the past, said, and this is after like a huge run-up in their business where they were the king of the optical networking world. They said, we're going to fall a little bit short of expectations. This was in October. And I was covering one of the biggest suppliers to that company. And your instinct there is to say, well, maybe it's just one quarter. Maybe we shouldn't talk about it. And so I didn't move quickly enough. And if you actually look at the expectations on December 31st, 2000, the analyst estimates for revenues for JDS Uniphase, at the time, it's got a new name now, were $6 billion. And when the year closed, sales were $600 million. And so you had a 90% fall off in demand for their product in 1 year, and that is a very hard thing to recover from. And so I think that as an analyst, you're just spending a whole lot of time trying to stay sane. I think the balance in that situation is there's this tendency, especially on the sell side. On the buy side, people can move much more quickly. Like you can sell a stock, you can decide you bought the stock, you can make a daily decision. When you've got a rating on a stock, the question is you put investors into this, and it's true that you missed the first leg down, and I think that's the best way to look at it. But then your question is, okay, my job is to try and understand what's going to happen next, and am I helping people out by putting a sell rating on a stock that is down 25%? And a lot of times the answer to that is no. Now, sometimes the answer to that is yes, and I think that's what you learn in inflection points. In inflection points, what you learn is that it's never too late to downgrade. And so I think that that's probably a pretty big lesson that we learned there. If you fast forward to I'll just tell you a funny story about the financial crisis, which I experienced in the room effectively because I was lucky enough to be working at Lehman Brothers when it went bankrupt.
Very lucky.
So, well, you learn from most experiences. And so this is just a funny story. I was working in a Tel Aviv office at the time, and so it was actually kind of weird because Israel is 7 hours ahead of the news that's coming out in the United States. And so they were going to go bankrupt at midnight as you move from Sunday to Monday. And so that's 7 a.m. this time. So, of course, you don't know what's going to happen. So but Sunday is a work day in Israel. So you go to the office and you're working, and then you're like, well, is there going to be a company here tomorrow? And so you don't know. Anyway, so Monday happens, and then on Tuesday morning, it became apparent because what happened in the United States is that Barclays came in, and most people at Lehman Brothers who kept their jobs didn't really even miss a day of work, maybe a couple of days of work while there was a little bit of uncertainty. And in Israel, it turned out, it took a little bit longer, but we ended up also becoming part of Barclays in the Israel office. And so that's how it all ended okay for most of us. But the funniest thing was on Tuesday when there was still a lot of uncertainty, we all got an email which said, can the person who took the coffee machine from the 21st floor please bring it back because we're not going home? So,
who was it?
I don't know who took the machine.
It wasn't you.
It was not me.
Okay, good.
So those are the kinds of things that you experience, because you look at it and it's an event on television, and then you're part of the event. And so, I've seen it from different perspectives. And I think the most important part, people say there's this famous expression, don't let a crisis go to waste. I think that's probably true. The only question is, are you smart enough to see the next one? I used to joke with one of the buy-side guys who I was very close to at the time. We used to say, the next time this happens, we're going to get it right. Now, of course, I don't think we did, but that's what you try and do.
I want to say tell a story about my relationship with Joseph.
Okay.
If I may. So our ways crossed several times. At the time, I was the IR director of Allot Communications, and Joseph covered a lot, and we traveled and did some NDRs together. And at a certain point, I moved from Allot to Orbotech. I got a text message from this monsieur, and he wrote to me, "Congratulations, you just moved from a strong sell to a strong buy." That's one thing. That's when I knew I made the right decision. Joseph, another questions, maybe on a different topic. A topic we haven't been discussing so far deeply in our podcast, but want to talk about ETFs and how do you think the rise of passive investing affected the role of sell-side analysts?
It's a really interesting question because you would think about it and you'd say, well, there's still an active market. And I'll just look at it from a couple of different angles that I think impacted, and I'll talk about where I think this is going. First of all, there's this expression that you always hear when you're in the active side of the business, and that includes the sell side and, of course, the buy side where we're focused on, because all of passive investing is also the buy side. It's just not a person you would ever speak to on the sell side, generally speaking. Though that is shifting, and that'll be part of the answer. And everybody always says, "Oh, now it's a stock picker's market." Like last year, it wasn't a stock picker's market, but now things are so tough, it's a stock picker's market, and this is where the real brains are going to make the most money. And hopefully that's true, and sometimes it is, and sometimes it isn't. I think when you think about what happened, though, is a lot of money, institutional money and retail money, went from active managers to passive managers. And what that means effectively, I think two things happened. One is the buy side shrank, which is not really, because I know portfolio managers, all of a sudden you're working at, one of these big named long only shops, and they don't need as many managers because a lot of their client money has moved to passive strategies, and people lost their jobs on the buy side because of that. On the sell side, I think what happened though is you end up with these, I think there was a biggest impact was on smaller stocks who don't get as much coverage, because the natural wave when these things kind of thing happen is to focus on large cap. And so the large cap, I don't think there was a very much impact to the large cap analysts. I think there was a much bigger impact to the small and mid cap analysts who were covering stocks where there just wasn't the volume, the interest, or the activity to support having research. And I think that's probably to the detriment of those companies and even to those investment opportunities, because I do think good research is actually very important to the investment process for the small cap and mid cap market because they are less known. But the problem is it's just as hard to build a good model on a small cap as it is for a large cap. And so the focus, I think, of the sell side had become more large cap focused. So I think that was one of the impacts. What I'm hearing now and what I'm seeing now, which is interesting, and it's past where I was a research analyst, but it's something that it's something I've picked up on, is that you see these launches of very, very specific focused ETFs. And so ETF has become almost an asset class with its own tax implications. And so you'll have these sector ETFs where you're effectively the manager is making decisions and it's passively traded in terms of allocation, but there's still a selection of what goes into the actual ETF. And so what you're seeing is actually at the bigger funds, the same guy that runs the active TMT fund also just launched a TMT passive or ETF wrapper. And so I think that that's one of the interesting developments that's going on right now.
Okay. Now, another topic that we actually covered to a certain extent is how not AI. So we talked about it from the investor relations perspective, but I'd like to hear, how when you think of AI and the role of the sell-side analysts, how do you see the impact today? And then also, what do you think is going to happen going forward?
So I think AI is a tool, and I'll elaborate. When I am old enough to remember when earnings reports came out, they were faxed to your office. And there was a real value based on whose faxes and what you could get. There was a real value. Some of the analysts in the department, and this continued for longer than I thought it should, they would write these first looks, and they would publish these reports that said, revenues versus expectations, income versus expectations, EPS versus expectations, and they would try and get those notes out faster because not everybody got the results at the exact same time. People continued to do that, but now everybody gets the results at the exact same time, and my assumption is that AI will do a much better job of quickly looking at results versus expectations, and that's not a job you have to do anymore. But frankly, that wasn't a very interesting job to do, and so it goes away. We talked about this a little bit as we were sitting before we came in here. If I highlight what makes good research, or what I think makes good research, and people could disagree with me about what makes good research, and I can talk about I'll talk about two of my favorite research reports, but I think I could talk about other analysts who made their names doing things. We talked about one report I wrote when Rami was at Orbotech, and one of the things that happened was one of the advantages to being slightly bilingual is you can read the Hebrew news, and there was a specific instance that happened to Orbotech where there was a little bit of a tax issue, and Globes published something which made perfect sense in Hebrew, and then it was translated on all the wires, and it made the situation seem much worse than it was. And so I published a note that was called Lost in Translation. Now, could AI have written that report? AI could have written that report if I plugged in everything and actually wrote most of it and did all the prompts, and it came back. But the creativity that went into that, the insight that I had and the ability to write that note, I don't think AI could ever replace. Because why would you write that note? And then the other one that I talked about was I covered another Israeli stock called Kornit. I thought that was a great company. And it's a great company still, in a very interesting technology application. And they missed a quarter, or they had a difficult quarter. And it had a difficult quarter because one of their big customers that they wouldn't disclose was building a facility, and there was a kind of a glitch or in the order pattern and so they didn't sell enough units that quarter. And they wouldn't say who it was, and they wouldn't say where it was. But using, I went to. It turned out that the customer was Amazon, and it turned out that by going to the Amazon job site, I was able to figure out that they were hiring a lot of engineers and support staff to be putting in a digital printing system in a new facility that they were building outside of Philadelphia. Now, could AI have written that report? I don't know, but I don't think so. And so I think AI is a tool. I think about it a lot like this. If you wanted to be a math genius before calculus, you only had to learn certain things. And all of a sudden, Newton invented calculus, and then you had to learn a lot more to be a math genius. And that's the same thing. You have to use all the tools that you have available. It raises the floor, but it also removes a lot of the things that you found tedious. I would hope AI removes the need to build past models as you think about the future. So use it as a tool, and it'll be very, very effective. I don't think it replaces creativity just yet. I don't think this is a conversation about whether we all think AI has its own conscience. That's a whole different story for a different time, is my guess.
If I may barge in, actually, the example you brought in reminds me of another example when I was actually the VP of IR at NICE. One of the analysts that was covering the company had an assumption that there was a certain company that they were looking at to buy. And what that analyst did was he called each and every hotel in the city where that company he thought they would be buying was asking supposedly looking for the CEO and CFO, as if they were booked into one of the hotels. So that's another.
Yeah, and that story is a great example because it's true. If you had a good AI agent, you could make all the calls to all the hotels faster. But I don't know if that AI would have figured out that they should call the hotel. And that's what makes a good research analyst. And that's what's always made a good research analyst. And I'll just throw this out there. When companies think about research analysts, when an analyst decides to cover a stock, and I know that you guys are going to address this in at least one episode, when an analyst decides to cover a stock, or when a company is thinking about picking an analyst, you're guaranteed 8 bad research reports a year. You're guaranteed a preview, and you're guaranteed a post view on every single quarter. That is not where anybody is going to say, or it is very rare for somebody to say something interesting in one of those reports. Mm-hmm. And a good research analyst, and the best research that you should be looking for as a company, I believe, is those other reports that research analysts write that prove that they know the sector, where they're looking at what's happening that the company is not telling them and putting together a real thesis for owning or not owning a stock. And that's what's going to be interesting. And if you end up with analysts who just write those 8 research reports every year, you do not have good coverage.
True.
Yep.
If I may just complete your Orbotech story from the other side, being on the other side. So just want to say that on the morning when Globes published the Hebrew version of the news, the stock was 8% down in the pre-market trading, and demonstrating the power of a live, high-quality analyst. There came Joseph with this lost in translation note, and the stock opened at 0.
Which proves to you that
Thank you, Joseph.
Which proves to you that an analyst with a little bit of reputation on a stock can move a stock for about a day.
But it's a good day. Joseph, let's move to an item we talked about, a topic we talked about a lot, the IPO process in our podcast. So you were involved in several IPOs throughout your career as a sell-side equity analyst. Can you describe the role of the sell-side analyst during the IPO process?
So this has changed over time, and it's a great question. And I think in the current age where you have a real separation between investment banking and between research, the role has changed a little bit. And there's also this, there's this almost a stigma attached to research and their role in an IPO because of that separation. But if you think about an efficient capital market, it's really important that the research analyst is involved in, it's really important as a research analyst. Like if you're a research analyst, you should want to be on every IPO. That doesn't mean you pitch the IPO, but the IPO process is where you will learn the most about the company. You will have the most intense period of education within the company. You will have the most time with the CEO and the CFO before they go public. Because once a company goes public, and you could talk about this in a couple of different ways, once the company goes public, the time constraints on management are severely impacted when it comes to the ability to talk to people. Because, I could steal 7 weeks a year from a CEO just in talking to investors if I wanted to just go to every interesting tech conference out there. Mm-hmm. And so during that IPO process, you really get to know the company really, really well. And if the management team sticks around long enough, you know them exceedingly well. And so what you learn about the company in a totally transparent and totally compliant and public information, it's not even public information at that point, and it doesn't need to be. So when you build that model, you see things that they're going to be disclosing, but there's no disclosure yet. Yeah. And so that's a really important part of building a model. And then what happens after you've built the model and you've gone through that process, you lock that model in, the company files, and then begins a process of investor education. Now, this is a different process than happens in Europe, where you can write a research report ahead of time with a rating, I believe. In the United States, that's not how it works. You do not write a research report. You are not allowed to send out any of the materials, but you are allowed to go through your expectations for the model and how you built the model with investors. And you end up the company goes on the road. I don't know if they do it with Zoom these days, but the company goes on the road, they meet the biggest investors, and then those investors call you as the research analyst, and you end up spending a ton of time really doing investor education, walking through the model, talking about the business. These are companies that these days with the top tech companies, and this may be true in other sectors as well now, a lot of people know the company a little bit because there's mezzanine rounds and there's investment that is private. And so a lot of the top analysts at some of these places know the company, but a lot of people don't know the company at all yet. Mm-hmm. And so this is your real opportunity to become, what do you want as a research analyst? That's a question I don't know if you asked, but mm-hmm. How do you succeed as a research analyst when effectively you've got 15 competitors writing the same notes on the same companies with the same earnings reports and the same details and the same conference calls? And the answer is you get known by certain people as having insights in the sector, and you want to have a big, big base of clients on the buy side who rely on your thought leadership when they make investment decisions. And the way to do that is to show and to demonstrate that you have a deep knowledge of the sector and of the companies in the space. And when you are one of 2, 3, 5 analysts who are doing that during an IPO process, that is the best time to win people over, because if you do a good job during that process, that buy-side counterpart will only come to you for the rest of the time that they're looking at that stock. And so it's a really important time to really do good work and to talk to a lot of clients. The last real big hot deal I did outside of Israel was a company called GoPro, very hot little camera company for a while.
Yeah.
Not that hot these days, but it was a very exciting IPO, and the story around it was just, I do not believe I worked as hard during a 2-week period in most of my career. And so it's a very exciting process, but it is also by the time the GoPro offering happened and they rang the bell on NASDAQ, my children could give the GoPro pitch because they had heard me do it so many times.
If you think about, obviously you've been involved in many IPOs. And by the way, the comment you made about Europe versus the process in Europe versus the U.S. was also made and discussed by Ishay Francis from Citibank, that was our guest on episode number 10. So it's interesting, to hear the same commentary also from people from different angles. Now, specifically, if I go back actually to the question I wanted to ask you, and obviously you've been part of many IPOs as an analyst, is there one or I don't know, 2 examples that I'd say stand out in particular when you think of them, meaning that you had a really significant role?
I think anytime when you're the lead analyst, you have a significant role. And so I think the important part about all of this is to take the information from the company and put it into a reasonable framework that you believe in. And the thing about the IPO process is that once it's locked, it's locked. And so if you don't feel comfortable with those numbers, you run into some real regulatory issues, actually, because there's a number, the company files and there's a range of prices on that. And what happens now is, and there's a time period, and it depends on the kind of company, but it's usually 25 to 40 days after the company goes public in the United States where you can publish research with an actual rating on it. And a lot can happen in those 25 to 40 days. And also, when you're an analyst, sometimes your bank is working on a deal and you don't love the company. And so I think keeping your integrity during that process, putting the right rating on it within the framework, because effectively, if the company files and goes public with a range of $10 to $15, $10 to $12, and the stock is trading at 8, and then you come out and say, I want to put a hold rating on it, or I want to put a sell rating on that because market sentiment has changed or multiples have crashed, or there's just new news out there, you have to really come to a very significant decision that you are confident enough to say, it doesn't matter what we put on the front page of that report. This is what I believe the stock is worth now, and here is why. And so I think the most important part about being an analyst all the time is the ability to balance the push and the pull, and with your own integrity of where you believe the market should be going.
Yeah, you mentioned regulatory changes. Can you talk about maybe the how the analyst role in IPOs process have evolved over the years with all the regulatory maybe burden, I would say, or changes?
So now you're lucky at how old I am. I am old enough to remember as a tech analyst where you would call up the West Coast bankers and you would say, hey, I'm coming out to the West Coast. Let's go visit 20 companies in 5 days together. And you go there on a Monday and you do 10 meetings a day with the bankers.
Oh.
And there are other stories about all of that. And all of that changed, of course, because there were gross misuses and abuses of that system. But at that point in time, I was on pitches where you would go with the bankers and you would hear the pitch to actually win the business. And research analysts were a significant part at times of winning business. And that's probably where some of the regulatory rules came from. Mm-hmm. Like all regulations, you could argue that it went too far or it didn't go far enough. But I think that was a correction that was in place for some abuses during the tech bubble that I think people think are still important enough to be in place.
Okay, now we had also, Rami brought up a couple of instances or companies, actually at least two, that you worked together. You were IR and Joseph. Yeah, and Joseph was research analyst. We also had that privilege. And
I don't want to. I think there must have been at least one time where I beat you up about my modeling firm. Nice that we probably don't want to get into here, but that might be a story for a different day.
But the question
we can do a follow-on episode if you want.
The other question I wanted to ask you was basically, what do you think makes, I'd say, a good IR person? Okay, when it comes to the relationship with the sell-side analyst, what do you view as a good IR person?
Well, it's a communications role. And so I think the most important things are clarity, transparency, frequency, and access. And what does that mean? It means the company has to have a message, and you have to be able to tell that message, and you have to be able to tell that message through good times and bad times, and you can't not hide the phone when you miss the quarter, because you're going to miss the quarter. Everybody misses a quarter. And when I say access, and I think this goes a little bit back to the comment I made during the IPO process, and this is where IR is a fine line, and it's a much harder job than I think people actually think about a lot of times, and that is IR is in some ways a gatekeeper. And I covered a lot of different stocks in my career, and I would say at some companies, it was obvious that most of the time you were going to be speaking with the IR person, but the IR person had to answer all of those demands and had to be the right gatekeeper and had to have the right answers. And there were times where you did not speak to the IR person at all and you went right to the CEO. And sometimes that's because the CEO embraced it. And sometimes that's because you started, and this I think is an important thing for startups to consider. If you bring in IR too late and all the analysts already know the CEO and the CFO, it's more difficult to transfer them away from you during that. And it's not because of a respect and it's not because of capability, it's because of the relationship. And if you can hear it from the CEO, you don't want to hear it from the IR person. And I think the job of a good IR person is actually to convince and to set the bar high enough where you can say, this is a question for me. I'm going to take you to the CEO or the CFO when you have a real question, or I'm going to give you the right time and I'm going to allocate their time for real meetings, for real in-depth conversations. But if you're going to ask me a question that you can find the answer to in the report, I'm not letting you talk to the CFO or the CEO. It's not worth their time. Right. And so that balance, you have to be strict. And I don't think that that's such an easy thing to do because a lot of times the IR person is the youngest person in the room. And a lot of times, and this is true in the United States at least, a lot of times that person is a woman. And you can have I don't want to step too far into that conversation, but I think sometimes that plays a role in the way some of the aggressive analysts kind of roll over IR and go right to the CFO in a way that's probably not good for the company, not good for the analyst, and not good for the whole relationship.
Yeah, reminds me of something. Not that actually. I think my experiences, as being an internal IR, were good and different, and I hope I was doing a good job because I got the calls directly usually. But just your comment about in general, it's more of a man's world than the whole financial markets.
IR?
In general, financial markets, the capital markets.
I will say a shout out to the women that worked for me at Barclays. The best analysts who have ever reported to me were all women.
I'm sure.
Makes sense. Makes sense.
Okay.
Maybe to complete taking the opposite angle of Daphna's question is when you look at IR and professionals, what are the some of the most, I would say, common mistakes that IR professionals are making with dealing with analysts?
I think the biggest mistake people make in this business is taking it personally. And the biggest place where people take it too personally in the relationship between investor relations or companies in general and the analysts is with the rating system. Mm-hmm. And so if I have a sell rating on your stock, that is your only opportunity to get me to change my mind for the better. And I think that people take the sell rating very personally. Mm-hmm. And I think that is a big mistake. And there should be as much access and as much attempt at explaining the story and re-explaining the story. And if you really have conviction as a company that the sell rating is wrong, you should be spending more time with the sell-rated analyst than with the buy-rated analyst. And so I think, because remember, the next move for a buy-rated analyst is to downgrade you.
Exactly.
And so I think that is something that it takes a while to get right and to understand. The other part of that is with the client base, because what's interesting about IR and the sell side is that you're both really caring about the buy side. And so you have this shared interest and a shared client base to a certain degree, because you want the buy side to own your stock, and I want the buy side to come to me for advice.
Mm-hmm.
I experienced, and maybe it's changed a little bit because I haven't been an analyst for a few years, but I'm pretty sure it hasn't changed that much. There's this reluctance, or I've seen a reluctance sometimes to talk to different kinds of investors, meaning I don't want to talk to that guy, he's probably short. I don't want to talk to the guy, he only wants to hold the stock for a day and he's a day trader.
Mm-hmm.
I only want to talk to people who are going to be in the stock for, I don't know, 3, 5, 10 years. I don't want anything else. And I think that that's just a short-sighted. I know it's hard to get over that, and I understand that it's hard to get over that, but I think that is probably a big mistake, because a lot of the times the smartest conversations you're going to have are going to be with the people who are most negative about where you are currently. And the question is whether you can take that criticism and move forward.
Also, in general,
Correct.
I think and it's also something that we covered quite extensively in our episodes about targeting, for example, was about, and also first 100 days, and we covered it quite extensively, is the fact also that, again, you wouldn't want, or we don't think, Rami and I both agree on it, it's right to only focus on one type of investor, just like also, in a way, also when your sales team, okay, you won't necessarily only focus on one type of client, you'll need diversity. So I also taking it from a different perspective.
Yeah, and to Joseph's point about, let's say, negative or not overexcited rating, I think I view it as an opportunity, because that's gonna move the share price upward once an analyst changes his or her opinion from I don't know, from hold to buy or from sell to hold or anything like that.
And also
I worked for a guy who everybody thought was a counterindicator.
Was a what? Sorry?
A contraindicator. Anytime you put a buy rating on, everybody knew to sell the stock. So, everybody serves a purpose.
Also, I completely agree and can relate to your observation or comment on don't take it personally. Many times management teams will take it personally, and I think it's also one of the roles also of IR really to explain it's not personal.
Also, don't forget, there's a rating system.
Right.
And you have to understand that if an analyst covers 20 stocks, almost every firm now requires 10% to be underweight, and the truth is that's the way the market works.
Yeah.
You're not going to be situated. Not every stock goes up all the time. So let's just take the rating, put it to the side, and make sure that the analysts understand the story. And their rating could be because of a lot of different reasons that don't fit in specifically to your company on a specific day. And are you better than every company in your sector? Because a lot of companies have relative rating systems. And so you might be the biggest buy in the world, but there's 10 companies and they're all buys. And so one's a little bit better than the other.
Mm-hmm.
Another question I have is, and let's assume that we're, within the lines of the regulatory disclosure, do you think, but if I talk about disclosure and how much a company discloses to a research analyst, do you think there's such a thing as too much disclosure?
I think there's useful disclosure. I don't think you can over-communicate. As a research analyst, what made me happiest, and I think this was the heart of a lot of the conversations we had when I was covering NICE, the most important thing to me was to be able to build a model without the company.
I remember one specific conversation in London, especially. You know what I'm talking about.
And so if you can't, if there's not enough disclosure for me to take external data points and get comfortable with the number, and I just have to think about this as taking company guidance, you don't feel good as an analyst, and it's not good work. The good work is if you can, and it's not always possible to build every single bottoms-up piece of a model in such a way that you can build it entirely independently. You have to think about different macro components and entry points into the model. But I do think there should be enough disclosure. I think there are two things that are important. One is if your competitors are disclosing something, and this is one of the things that came up with a lot of different Israeli companies that I covered versus when I was covering stocks where there was an American company and an Israeli company kind of in the same sector. And I would say, but they're disclosing it. And they're like, we can't disclose that for competitive reasons. And I'm like, but they're disclosing it. So why are you're only consensus gets built by the buy side and the sell side with or without a company. And you should want as a company, I believe, to within the parameters of what you can live with as a company, give people enough information to do the right comparisons. And I think that that's really important.
Yeah. I certainly remember one specific conversation. Are we talking about the same one in London?
I don't know that it was in London, but I know that we had conversations about building a model.
Yeah. Okay. You wanted to ask something?
No,
No?
that's for the next episode, right? The London conversation. We want to move to another part of this episode, focusing on career progression. So my question is for someone who spent several years as a sell-side analyst, now I'm taking it to the next phase of your career, or in investor relations, which is not where you've been, but we also think about that in the context of investor relations. What do you see as the natural next steps in their career path?
So I'll tell you what I've seen in the research side. Now, I spent my whole career in research on the sell side, but I also managed a bunch of people, and I watched where they went in terms of where you went from being a sell side analyst. And the answer is actually very different in the United States than it is in Israel, just because of the breadth and depth of the financial markets. If you like analysis and you still want to be in the markets, the obvious move, and this happens, but it happens usually fairly quickly, is a move to the buy side. Now, not every sell-side analyst is good at being a buy-side analyst, and one of my favorite sell-side analysts moved to the buy side and he came back to the sell side because it's a different job, and you have to understand the differences between the job. The other answer to your question is you don't actually ever have to switch. If you're a good sell-side analyst, you can be a good sell-side analyst for a really long time. And we both know this, Rami, because we both left the communications hardware kind of sector, and a lot of the people who are still ranked in that sector are people who started when we did. And there's
10 years ago.
10 years ago, 2 years ago. So maybe they're still looking. And so it's a pretty good career path if you can, it's a hard job in terms of the wear and tear and the amount of time you have to focus on it and your ability to take breaks. But I do think it can be a very rewarding career to be an expert in a sector for a very, very long time. The crossover, I think, for where IR and analysts can move is actually you understand companies from a very intimate way. And you can move to business development and strategy roles. In fact, I opened up LinkedIn this morning, and one of the analysts who used to work for me in the healthcare side, he just announced that he had moved to one of the companies in his coverage universe. And so I think that that's a very common path still. It's an interesting path, and I think it happens quite often. I think the other, and I do think, but there's room for growth in most of these jobs, and so I don't think that there should be any rush. Where I happen to move because of my sector coverage and because of my own biases is that you can also move into management kinds of roles. You can lead teams. You can become part of research management. That's a whole different career path. So those are the most obvious things that people do if they are. I don't know if they're not interested or they become tired or they're looking for something else after they've got a couple of good years on the sell side.
Can I ask a personal question? Kind of personal.
Of course.
Okay, let me try. What actually triggered your move to, I'd say, wealth management, what you're doing today at EFG? And are you going to answer? Are you okay with that question?
I'm okay with that question.
Okay.
Not too personal.
And if you could highlight, I don't know, the number of, I'd say, traits or experience that you've gained throughout the years that actually help you in your current position.
So most of a lot of people, I try as I get grayer or balder, when people are younger, the next generation comes and asks for career advice, I try and give time to that. And one of the things that I have in talking to a lot of people and listening to successful people much more successful than I am, talk about the career trajectories is, you've got people who've planned everything out, and then you have people who kind of have a loose plan and move towards certain things. And the thing that I've told certainly my children, but also most people who've ever worked for me, is never say no to a cup of coffee, because you just don't know what could be interesting to you. And so most of the moves that I have made have been unplanned, and the best time to find a job is always when you have a job. And I think that probably will never change, because you hold all of the cards at that point. For me, the move to, after a little bit of, when I took the job, my last job at Barclays, I was commuting between New York and Israel for a variety of personal reasons. That takes wear and tear. I could talk to you until I'm blue in the face, and I still am part of a WhatsApp group of people who travel and do that commute on a weekly basis about why it's not so hard and it's so good and it's so easy, and it's a 12-hour sleep every Sunday night, and you wake up in New York at 7 o'clock and everything's good to go. And the answer is that takes a wear and tear on you. And so when I was offered an opportunity to become local again, that became very attractive to me. Now, how did it work that I ended up in wealth management? Now, that's an interesting question, and I think there's a couple of different sides to it. And I'll tell you where I think my experiences are helpful. And I use the example of, just a company under coverage. When you're a research analyst, one of the most interesting things that happens is you wake up in the morning and you've got a buy rating on a stock or a sell rating on a stock, and boom, somebody acquired the company. And then you're like, oh, and you got to do this model, and you're looking at the synergies, and you're rebuilding the model, and is it a buy, and is it after tax and post tax, and how's this going to work, and regulatory approvals. And it's a very interesting thing to be a part of. And one of the things when you're on the sell side that you don't really think about is, hey, some CEO is about to become an ultra high net worth individual. And now my job is to think about what that CEO is going to do now that he is an ultra high net worth individual. And I think the crossover that makes my experience helpful in talking to those ultra high net worth individuals is that I have a very strong market experience, and I understand financial markets, and I have a experience with the ups and downs of the markets. And when there was the head of sales at Barclays used to say, people would, they would complain that we were dressing too formally. And he would say, there's nothing casual about managing other people's money.
Nice.
And he was right. And I think that is the part of where I come from that I think is very helpful in where I am. And if you think about, or when I think about our strategy at EFG, which is a startup in the Swiss banking field in Israel, our goal is to become known as the bank where you will get the best content from your local team in the market.
So thank you. It's interesting. And actually, it's an interesting, I'd say, perspective. And I think it's time to wrap up.
Yep.
Yeah. So again, I'll maybe end up with where I started in the beginning, saying it's the first time that we've actually recorded an episode in English. Mm-hmm. So thank you, Joseph.
How's my English?
Not bad.
It's been improving.
Not bad. Now, I think there's one of our favorite, actually, close to end items is called the golden tip.
Yeah.
Okay. So, Rami, do you want to explain to Joseph what the golden tip is?
The golden tip, I think you need to explain it because it's named after you, Daphna, Golden.
Yes. Okay. So you can take it from here with Joseph, or you want me to?
I will. Okay, so we want you to give our listeners a golden tip. So, Joseph, you have the honor this time, and maybe can you give us the main takeaways for those who wish to pursue a career as a sell-side analyst? That's what we focused on in this episode.
So first I want to say thank you. It's always nice to sit down with some old friends who have taken this podcast to a next level. And I think investor relations is a really interesting place to focus on, especially for Israeli companies where the criticism in the past was they don't do it well. And I think if you look at Israel Tech 2.5, which is probably where we are, maybe we're at 3.0, the level of communication and the level of management is just at such a better level than it's ever been that I am really, really excited about Israeli tech and where this is going. So I think that that's great for markets, and I think that you can really help people with that in terms of the communication side. And I will give you a golden tip that I heard from a product manager when I was younger, and it's influenced me to this day. And that is a very simple sentence, which I will then explain a little bit, which is be right with humility and be wrong with integrity. This is the markets. It goes up and it goes down. If you get something right, do not take a victory lap, as we used to say, because you might be wrong in 5 minutes. And so be right with humility. You did your work. You got it right. Put your head down and go on to the next thing. And be wrong with integrity. If you get a stock wrong because you understood the company, but you got something wrong, the stock went against you, somebody changed interest rates, whatever, that's okay. If you got something wrong because you didn't understand how the company worked, that's on you, and that's a big mistake. And so as a good research analyst, make sure you've done the work. You'll get some right, you'll get some wrong, but you'll have a great career.
It's a good golden tip.
Yeah.
Okay. So thank you.
Thank you.
For sharing your insights. And I think it's time to really wrap up and ask our listeners, as always, to provide us with feedback, comments. And Joseph, thanks. It was great.
Thank you.
Yeah, thank you. Really enjoyed it. Thank you, Joseph. Thank you, Daphna Golden.
Thank you, Rami Rozen.
Take care, everyone.